Ashraf Laidi is with us, Chief Global Strategist at City Index. Ashraf, good morning to you. And again, I think it's worth just reiterating the point that Cyprus in itself is a very small economy with a very, very large deposit base. The banking system has outgrown the size of this economy largely because of the foreign deposits, Russian deposits that are in the banking system here. But the market, interestingly, was perhaps less worried about this yesterday, ostensibly, than one had imagined going through the weekend with this news.
Right, so this is this is the kind of shock that was mainly concentrated on the euro. It was, the Dow futures was down 80 points. Not because of, as you said, because the size of the country's GDP is so large that it's going to weigh on the growth of the Eurozone. It's less than 0.2% of the entire region. But it is really of the surprise element of the confiscatory nature.
But even then, I mean, you say the euro took the pain, but even then the euro bounced pretty strongly off that 120.80.
And if there was anything to sell off, it was the euro. And what's interesting, so basically it was not that that the same thing was going to happen in Italy or in Spain, even in Italy where the country has no leader. So they were unlikely to resort to that.
Is this a ring-fenced issue then in risk terms as far as you're concerned for peripheral Europe?
Yes.
There is no contagion risk.
Okay, this is the thing. We are redefining the meaning of contagion. This is not the contagion where basically you're selling the bonds of these nations because these nations are not able to raise money because the cost of debt is rising. They're not able to go to the bond market. These are the fears we used to have in summer of last year because of Greece, because of Italy. This is another kind of contagion, the fear that you are able to confiscate people's money in other nations. But then people woke up and it took them just before lunchtime London to realize that's not likely to be the case. I just want to say something else. The only thing that was able to actually move was this thing called gold. Gold that wouldn't even go up when the central banks would say we're going to buy bonds. Gold was finally able to react to that.
Modest, wasn't it? I mean, we retook the $1,600 an ounce level, but
not against the dollar, but against euro. In euro terms,
it was a modest. Okay, so where do we go from here? Because the euro has rebounded from that move. Okay, so give me a line. Do I want to buy or sell the euro at this point?
Right. So here's the thing: the downside of the euro is going to be limited. By the reminder by Bernanke tomorrow that even though we have such an improvement in the US economy, we're going to continue to pump this money into the system that is going to cap the dollar, is going to support the euro around 128 to 100-day moving average. But here's the thing: if you want to play the euro, you play euro x periphery, which is what? Which is the Swiss franc. Today you're going to have the ZEW survey from Germany. On Friday you're going to have the IFO. This is going to continue to rise and rise and rise. The bonds yields are going to continue to go up. So you basically want to play the Swiss franc as a play, basically.
So what you're saying is we've seen the risk rally and the markets responded, and we felt like we were clear of all these issues, but Cyprus has basically reminded us of the normal that does exist around Europe. We haven't conquered any of these issues, and therefore the safety bet that's been in place in markets needs to remain as such. It
needs to remain, but not to get carried away and say we're going to send the euro back towards 135. Actually, just want to say something. Yes, we were expecting the euro to go to 140, and it didn't happen, so we were wrong. But we don't expect it to go towards 125 or 124 because there is the German element, there is the core element of the eurozone, which remains quite solid. And in the foreign exchange market, playing the currencies, it tends to be overbought very quickly.
Solid now, because if you look at some of the reaction across German newspapers as well, and we know there are significant deposit holders in Germany, these people are also concerned about their savings because a precedent has now been set in Cyprus about targeting savings, hasn't it?
Right, but the non-resident nature of the involvement of Cyprus, such as the Russians, such as the German and Russians, is not really that of a major factor. The other thing is that the German taxpayer is not expected to foot the bill for Cyprus. That's why they're going into the depositors, and that's one of the reasons why the German factor is expected to prop up. But I'm saying, how do you play that? Do you play that through the Swiss franc, buying the Swiss franc, selling this currency, the sterling, buying the Swiss franc, selling the yen?